We just got the latest inflation report, which says inflation came in lower than expected and the stock market loved it. The Dow Jones jumped by more than 700 points, but there's one part in this lower than expected inflation report that a lot of people are overlooking, which is lower than expected inflation does not mean lower inflation. Let me show you what I mean. In September 2024, just a few months ago, inflation came in at 2.4%. By October, it went up to 2.6%. November, it went up to 2.7%. And we just got the December inflation data, which says that inflation went from 2.7% in November to 2.9% in December, which, you guessed it, is higher than where we were before, which means inflation is going up. But the reason why a lot of people on Wall Street were excited is because they're saying this higher inflation report is actually better than what was expected. Now, there's a couple things that I want you to understand here. Number one is that core inflation did fall slightly from 3.3% to 3.2%. Core inflation, remember, is when you take a look at the inflation numbers and you extract what the government and the Federal Reserve Bank calls volatile numbers. Volatile numbers are food costs and energy costs. So if we take out food and energy costs, core inflation fell from 3.3% to 3.2%. And the second thing that I want you to remember is that stocks are emotional. They don't always move based off of logic. They move based off of people's perception as to what's going to happen in the economy, especially in the short term. And so when people are excited that, hey, this inflation wasn't as bad as I thought, that means good news because it wasn't as bad as people thought. And the second piece of news that really changed things yesterday had to do with banks, because JP Morgan Chase Bank released their earnings statement. And what they said is not only did they make more money than expected, not only did they make the most money ever in 2024, but they broke a record for all banks in America in the history of time when it comes to profit. And not just that, they're also expecting a big year in 2025 because they're hoping that President-elect Trump is going to remove some regulations, allowing them to make even more money. This is what Jamie Dimon, who is the CEO at JP Morgan Chase Bank, had to say. Businesses are more optimistic about the economy, and they are encouraged by expectations for a more pro-growth agenda and improved collaboration between government and business. But I'll dig more into that in just a minute. I want to go first into where we are seeing more inflation and where inflation is not. If you're subscribed to Market Briefs, we already covered this in our newsletter today. Market Briefs is my free financial newsletter where every day my team is breaking down what's happening in things like the economy, the stock market, the housing market, the crypto market, the global economy. It's a fun and witty and easy to read newsletter. We have hundreds of thousands of investors that read Market Briefs every morning to stay up to date on what's happening. So if you'd like to join Market Briefs for free, I have the link for you to join down in the description below. But the places where we saw the highest inflation over the last 12 months are, number one, auto insurance. Number two, airfare. Number three, housing costs, which include buying a house and renting a house. Number four, education. And number five, restaurant meals. The places where we saw the lowest inflation, meaning falling prices, are number one, rental cars. Number two, toy prices. Number three, electronics prices. Number four, appliance prices. And number five, grocery prices. Now, the thing that I want you to understand about inflation is that inflation compounds. And what I mean by that is when you hear the news that, hey, inflation is not that bad anymore, the inflation rate is not that bad anymore, the inflation rate that we're seeing today in 2025 is on top of the inflation that we saw in 2024. And that's on top of the inflation that we saw in 2023, and that's on top of the inflation that we saw in 2022. So inflation compounds. And remember, we saw very high inflation in 2022, we saw very high inflation in 2023, and inflation cooled a little bit in 2024. But that doesn't mean that the prices of things fell. It just means that the prices of things are rising less fast. And the problem and concern here is that wages, especially during 2021, 2022, 2023, did not grow fast enough to keep up with inflation. We saw that between 2019 and 2024, the median household income in America grew by around 20%, while reported inflation is around 23%. So incomes did not keep up, or median incomes did not keep up with reported inflation over those 5 years. But the headline that a lot of people like to talk about is that towards the end of 2024, reported inflation was less than reported wage growth, which means hey, incomes might be rising a little bit faster than inflation towards the end of 2024, but that doesn't make up for the big price growth that we have seen over the past number of years. So sure, maybe you get a raise, but that doesn't make up for all the big price increases that we've seen. Now, of course, some raise is better than no raise, but this is where it's important to understand how inflation compounds, to understand how this impacts the economy on a broad level. Because what we're seeing in many different instances is we have a subset of the American economy which is digging deeper into debt, deeper into credit card debt, that is digging into their savings because the cost of living has outpaced their incomes, which is of course a concern. Now, the second thing that I want to talk about in this video has to do with banks, because this is a topic that I talked about a few weeks ago, and it's very interesting to see how this is playing out with bank profits over the year of 2024. Now, JP Morgan talked about how they broke a record with profits in 2024. Goldman Sachs talked about how they had a great year. Wells Fargo talked about how they had a great year. And the things that they pointed to are, number one, there was more trading volume, especially towards the end of the year. So these companies, these banks made more money because after the election and after the Trump effect, more people were trading stocks, buying stocks, which made more money for them. We started to see an increase in investment banking revenue, which means more mergers and acquisitions was happening. But the other part of this that I want you to understand has to do with net interest margin. And this is important for people to understand because this impacts the average person. So in 2024, you may have heard that the Federal Reserve Bank, which is the central bank here in the United States, cut interest rates. But over the year of 2024, mortgage rates didn't go down. Mortgage rates actually went up. Getting a car loan rate went up. So interest rates on your debt went up while the federal funds rate went down. Why does this matter? Because the rate at which banks borrow money from one another is called the federal funds rate. Think of it like the wholesale rate that banks have to pay to buy that money. So banks are buying money at the federal funds rate, and then they're selling it to you at your mortgage rate or your car loan rate. And so when the federal funds rate falls, but your mortgage rate goes up, this spread starts to change, it starts to rise. That spread is called the net interest margin. And what we're seeing is that net interest margin has generally been going up as mortgage rates, as interest rates have gone up. And the reason why mortgage rates and other loan rates have been rising has to do with concerns about Treasury yields. Now, over the last couple of days, we saw Treasury yields fall a little bit. But what that means is if you wanted to lend money to the United States government, you wanted to go out and buy a Treasury bond, the interest rate that the government pays you is called that yield, a Treasury yield. And when people are concerned about inflation, when people are concerned about the national debt, when people are concerned about the dollar, they feel less comfortable lending their money to the United States government. But the government still needs money because we all know that the government keeps spending a lot of money that they don't have. And so to incentivize people to continue lending money to the government then has to raise the interest rate that they pay you. So as the Treasury yields have been rising, that has been pushing up mortgage rates, it's been pushing up student loan rates, it's been pushing up car loan rates and all other types of debt. And that's what's been causing this net interest margin to rise. And what I was talking about in my previous video is that this is something that is good for banks because that means they get to make more money on each loan that they issue. Now, of course, we know that the number of mortgages being issued is not the highest. The number of car loan rates being issued is not the highest, but it's something to pay attention to because, well, banks love the idea of borrowing money from a cheaper rate and selling it to you at a higher rate. And this is one of the things that we're starting to see now with JP Morgan and Goldman Sachs and Wells Fargo talking about record profits. At the same time at this happening, we're also starting to see more and more companies push for efficiency. This is something that we've been seeing as soon as interest rates started to go up. When interest rates started to go up in 2022, what we saw is a lot of companies that were relying on cheap debt, free dollars, they started hiring people everywhere because money was cheap and plentiful, so they were trying to grow as fast as possible, as big as possible. But then as interest rates went up, companies said, we have to be more efficient. We actually have to get a return on this money so we can get some money back to our investors or to our lenders. And between 2022, 2023, and 2024, we started to see more layoffs. We started to see more companies downsize, start to be more efficient, more productive. Some of the things that they did was require employees to get back into the office. Some companies did layoffs, some companies went bankrupt, but we're starting to continue see that happen even in 2025. Meta just did a whole announcement on this. We're where Meta said that they're going to lay off about 5% of their employees, about 3,600 people. And what they're focusing on is, quote, low performers, because what Meta is talking about now is that they want to push for productivity, they want to push for efficiency. Now, for any company, that's a good thing, right? You want to be productive, you want to be efficient, you don't want to have a bunch of lazy employees that are not doing anything. But this is something I want you to pay attention to, because this is the shift. If you remember, when COVID hit, companies were struggling to find employees because people were making money from stimulus checks, unemployment checks. There was a lot of money out there, so people just didn't need to go out and work the way that you did before. And so you had a lot of people quiet quitting, you had a lot of people doing the great resignation. There was a lot of shifts happening. The power was in the hand of the employee. Then 2023, 2024, we started to see it kind of normalize. And this is what we want to pay attention to see what's going to happen in 2025, to see if more power is going to go into the hand of the employer or the employee. And what we know, according to the Federal Reserve Bank, is that they are expecting unemployment to rise in 2025. That's one of the reasons why the Federal Reserve Bank says they want to continue cutting interest rates in 2025 as a way to continue stimulating the economy. But of course, they risk stimulating inflation as well. That's why the Federal Reserve Bank says that they are probably only going to cut interest rates 2 times in 2025, which is a lot less than what Wall Street had originally hoped for. But now you can start to see what's going on. If the Federal Reserve Bank says that unemployment is probably going to rise and we continue to see unemployment rising in 2025, what does that mean? Well, that means more power could be going into the hands of the employer, and employers might be pushing for more productivity, might be pushing for more efficiency, which means if you have a job, you want to understand the dynamic. Now, I'm not telling you how you need to live your life, but the reality is you got to understand how the game works. Employers, no employer wants an average employee. They never ask for that. They say that they want good employees. They want the best employees. Every company in the world says that. So if you are just trying to get by at your job, this is something you want to understand depending on the situation of your company. And that's why it's important for you to understand what's happening in the economy, not only so you can understand what's happening, but so you can find the opportunity. Now, my goal on this channel isn't to talk about how to find a job or do other things like that. My goal is to help you be better with money. That way you can understand how to win in this economy, because the way that you win in this economic system is by becoming an investor. And the way you find the best investment opportunities is by understanding what's happening in the markets. And that's where I hope you get some value out of my videos. And that's why I publish market briefs as a way for you to stay up to date on what's happening. But it starts with the understanding what's happening. And then the second part is you being smart with your money. That means not spending all their money, putting money aside to invest, having an investing strategy, and sticking with it when markets go up and markets go down, because we can see even through the first 2 weeks of 2025 that markets can be very volatile, and little things can really shift investor emotions, and those emotions can move the markets up and down. And you want to be able to find the opportunities no matter what's happening, because nobody knows where the market's going to go tomorrow, nobody knows where it's going to go next week, and nobody knows where it's going to go next year. But there are ways for you to profit no matter what's happening, and that starts by having the right strategy and by investing in your financial and investor education. And with that, I'll see you on YouTube tomorrow.